Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers on this Wednesday, April 1st, 2026. We've got a fresh batch of AI-generated insights for you today, hot off the digital press from yesterday's market chatter.
That's right, Ethan. We sifted through a good number of posts and discussions, flagging a diverse group of stocks. I'd say the sentiment across the board is a real mixed bag today. Some highly optimistic outlooks, but also a healthy dose of caution where, the KPIs really demanded. It's an interesting blend of promising long-term plays and some very high-risk speculative analysis.
Absolutely. Let's dive right in with a big one, NVIDIA, or NVDA. We've seen a lot of buzz around them, and honestly, the AI-generated analysis is strongly bullish. They're showing incredible revenue growth, over 73%, and net profit margins around 55%. Plus, insider trading shows a massive net purchase of nearly 57.5 million shares. It really paints a picture of a company absolutely dominating the AI space, with significant upside potential. Our last rating was a stay away on March 31st, but with all this momentum and those stellar numbers, it feels like a major upgrade.
Well, Ethan, while that revenue growth is certainly impressive and the insider buying is a strong signal, we can't ignore some of the underlying metrics. Their price-to-earnings ratio is still quite high at 35.59, and that debt-to-equity ratio is a staggering 7.255. High leverage, even for a growth company, adds a layer of risk. We're talking about a stock that one user specifically mentioned they rode down from 110 to 88 due to leverage trading. So while the current picture is rosy, the volatility and potential for corrections remain real concerns. However, the sheer profitability and the consistent news about AI demand do suggest strong fundamentals. True, Brooke, but the current price is 174.4, significantly up from that user's entry, showing a strong recovery. The news is overwhelmingly positive, identifying NVDA as a top Goldman Sachs AI stock, expanding GPUs to AWS, and analysts maintaining buy ratings. The potential for future growth here seems, undeniable. For NVDA, considering all the insights, our AI-generated market commentary suggests a strong buy. All right, moving on to Datavault AI, DVLT. We've had it as a speculative gamble as recently as yesterday, March 31st. The community is quite bullish, pointing to a pivot that supposedly led to explosive revenue growth and even a first profitable quarter. They're talking about a 2026 revenue target of around $200 million and significant insider buying. Sounds exciting, right?
It really does, Brooke. We're seeing claims of over 1,300% revenue growth from 2024 to 2025, and Q4 2025 showing positive operating and net income. This isn't just growth, it's a monumental turnaround. With their focus on AI-driven data monetization and real-world asset tokenization, and that huge insider buying at 87.7% of total insider shares, it seems the market is starting to re-rate this story. The current price is way below analyst targets too, implying serious undervaluation. This looks like a definite upgrade from speculative gamble.
Hold on a minute, Ethan. While those claims are certainly headline-grabbing, we need to look at the numbers right now. Their trailing 12-month net profit margin is still negative at negative 2.02%, and their debt-to-equity ratio is extremely high at 6.4355. A company that's historically unprofitable and heavily leveraged, regardless of ambitious future targets, carries significant risk. Yes, they claim a profitable quarter, but one quarter doesn't erase historical unprofitability. It's a microcap after all. The potential is there if they execute perfectly, but it's a big if.
Fair points, Brooke. But the insider confidence, combined with the strategic positioning in these high-growth sectors, makes this intriguing. The news confirms their first profitable quarter and significant tokenization deals. Given the speculative nature but compelling growth story, I'd classify DVLT as a cautious buy. Next up, Nebius Group, NEIS. This stock was flagged as stay away just recently on March 18th. Community sentiment is pretty mixed, with some calling it worth shorting, but others highlighting its AI-plated businesses. Well, some users are really enthusiastic about NBIS, saying it's insanely and criminally undervalued. They point to its diverse AI-related ventures, data centers, self-driving cars, even owning a chunk of ClickHouse. They believe any of these businesses alone could be worth billions, and the company is growing at triple-digit revenue rates. It sounds like a hidden AI gem, just waiting for the market to realize its true potential.
Ethan, that's a very optimistic read. My KPIs are screaming caution. We're talking about an astronomical price-to-earnings ratio of 943.27. That's a huge multiple for any company, let alone one with a negative operating margin of negative 1.03% and a negative return on assets. They're literally losing money from core operations. While they're building AI factories, that doesn't mean they're profitable right now, and the market has priced in decades of flawless growth. The sentiment score is actually slightly bearish overall from the AI-generated analysis. Okay, that PE is certainly a head-scratcher. It is. So for NBIS, our AI-generated market commentary suggests you stay away.
All right, let's look at AST SpaceMobile, ASTS. This one has consistently been in our stay away or speculative gamble category, most recently stay away on March 26th. The community sentiment is leaning bearish on this one.
And for good reason, Ethan. The analysis flags ASTS as a stay away. We're looking at zero net profit margin, negative EPS, and negative operating margins. This is a company with a market capitalization of over $31 billion, yet they're not turning a profit. A user comment hits the nail on the head. Capital obliteration and no product with a hype marketing-based management team. Far lower before higher. Risk is not priced in at 28B market cap. That's perfection. Plus, their debt-to-equity ratio is a whopping 93.612, and we've seen net insider selling. I hear you, Brooke. But the space sector is hot, and ASTS is often mentioned as a growth company with high insider ownership. The focus is shifting to valuation and monetization, so the market recognizes the need for financial returns. They're at the forefront of a groundbreaking technology. If they can execute, the sky's the limit, literally. Yes, if they can. But right now, the fundamentals don't support the valuation and the risk for capital obliteration is too high. The KPIs show a company burning cash. For ASTS, our AI-generated market commentary concludes with a stay away. Let's turn our attention to Reddit, RDDT. This stock was a speculative gamble on March 28th, but the current sentiment is a bit more bullish. While it took a hit in Q1, there's a strong belief in its long-term potential. It certainly had a rough Q1, Ethan, dropping over 46% year-to-date. That high beta of 2.419 screams volatility. And frankly, while users are talking about AI partnerships and data value, Reddit has historically struggled with monetization. A price-to-earnings ratio of over 51 for a company with that kind of volatility still makes me wary despite the positive claims.
But Brooke, the AI-generated insights highlight a robust revenue growth of nearly 70% and a solid net profit margin of over 24%. Users believe it's literally printing money from AI partnerships and ad revenue growth and has better search intent than almost anyone but Google. We've even seen recent news of shares skyrocketing and Jim Cramer endorsing it. This isn't just hype. It's a company with strong, improving fundamentals starting to capitalize on its unique data asset. This feels like an upgrade for sure.
It's showing very promising signs of turning the corner with those growth numbers. But given its history and the high volatility, caution is still warranted. I'd lean towards classifying RDDT as a cautious buy.
Fair enough. Next, we have Micron Technology, MU. We've been back and forth on this one, with our last rating a cautious buy on March 24th. But today, the analysis is leaning bearish.
It is, Ethan. The overwhelming community sentiment, despite some recent gains, is to short MU due to memory market headwinds. My KPIs show an extremely high debt-to-equity ratio of 14.902. News reports talk about Micron target cut as memory prices slide, and Micron stock price target slashed after plunge. That combined with a high beta makes it incredibly risky in this environment.
I understand the concerns, Brooke, but Micron is showing incredible revenue growth, almost 200%, and excellent returns on equity and assets. There's strong demand for memory and AI data centers, and insider buying is significant. Some analysts are even saying to buy the dip. It seems like a battle between short-term headwinds and long-term AI-driven demand.
Exactly. It's a battle. And with that much debt, the short-term headwinds could cause significant damage. The volatility and the direct bearish calls from the community cannot be ignored. For MU, our AI-generated market commentary suggests you stay away.
Finally, let's talk about Berto Acquisition Corp, TACO. This has been a consistent stay away for us, most recently on March 7th.
And it remains so, Ethan. Our analysis indicates a neutral sentiment because, frankly, there's nothing for us to analyze. The only post is Happy Taco Tuesday, a food pun with no financial discussion whatsoever. And the KPIs? A big fat 0% for net profit margin and operating margin. There's no free cash flow data either. A company with no profitability or cash flow is a huge red flag. Its current price is hovering near its 52-week low.
Well, a promotion for National Burrito Day could give it a small boost.
Ethan, that's not going to move the needle on 0% profit margins. And with news about California's $20 fast food wage, if they operate there, profitability could actually get worse. There's simply no fundamental basis here for an investment. Our AI-generated market commentary for Taco is a definitive stay away.
So to recap our daily hunt for multi-baggers, here are today's candidates for deeper analysis. Investigate as buy, NVIDIA Corporation, NVDA. Investigate as cautious buy, DataVault AI Inc., DVLT. Reddit Inc., RDDT. Investigate as speculative gamble, Nebulous Group NV, NBIS. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in to the Daily Hunt for Multi-Baggers. We'll be back tomorrow with more AI-generated market commentary. Until then, happy hunting.